Hello class, this is Brian from financialtrainingschool.com and welcome to GT302 Hedging. So as an introduction, the Investopedia definition of a hedge is when you're making an investment to reduce the risk of adverse price movements in an asset. Normally a hedge consists of taking an offsetting position in a related security such as a futures contract. Common phrases include hedging your losses. This is most common and it usually yields a less negative outcome, meaning you might lose $50 instead of losing $100. Alternatively, people might also say hedging your bets. This is common as well, but this is neutral because the bet doesn't really say if you're losing or winning, and this usually yields a less negative outcome as well. Lastly, you have hedging your profits, and this is rarely used, but basically you use this when you're in the profits in your trading position, and this usually yields a less positive outcome, e.g. you might profit $50 instead of $100. And as I mentioned previously in GT210, capital preservation is a key. Some traders prefer to maintain capital over risking for a profit. So here's some insight about hedging. Usually when people think of hedging or say the term, they're usually trying to minimize their losses. That's the goal. Another way to think of hedging is to treat it as insurance, and this will be elaborated later on in the individual trading series, but every instrument has its own hedging methods. For instance, if you're trading stocks, you might buy a put or call option depending on what position you're holding. Or if you're simply trading options, either vanilla options or binary options or whatever options you're buying, you could buy both calls and puts to hedge your position, and this is commonly known as a straddle. But regardless of how the instrument works, there are three primary cases of hedging, and I'll illustrate these with drawings and explanations shortly. But just to note before we start, depending on what you're trading, all three cases can be considered straddles, because hedging in general revolves around the idea of bi-directional trading, because you have a current losing position or a current winning position, you're going to buy the opposite direction, and that's in the sense of two directions, to hedge your position. So they'll either have calls and puts combined, or longs and shorts, etc. So the first scenario that we'll be looking at is hedging your losses. We're going to start with the black line, then move to the red line. So originally you have a long position at the black line. You're hoping that price would go up, but instead let's say it goes down. And this is where each instrument will vary, because depending on how the instrument works, you may or may not be able to exit your position. But let's say you are. So if you are, then you would probably have some kind of stop loss in place. This was mentioned in the 100 series. So if you have a stop loss in place, you would exit the first trade, and then after some time you would probably chase down and enter the short, which is at the red line. Now, if you can't, then you would probably be forced to keep both positions, and then hopefully it would go down enough to cover your losses from the first position. Or if you got out and you enter the second one, which is the short, and that's chasing, you're hoping that it would go down enough to cover your losses that you already took from your first trade. So let's just analyze the three possible scenarios, because it may not be in your favor, because if it doesn't go down enough, then it won't cover your losses initially and you'll just end up losing anyways. But with hedging, we're trying to minimize the losses as much as possible. So here are the three possible outcomes. In a perfect world, price would continue to move down, and depending on how much, your previous loss might actually turn into a minor profit. But that's only in a perfect world. The ideal situation is price continues to move down, but only enough to reduce your initial big loss into a small loss. And that's the whole essence of hedging, is to minimize your losses, and that's it. A bad situation would be if price bounces around and it actually ends up in between your initial position and your new position. So you entered here, you exited for a loss somewhere in between, and then below that you entered a short, but then it ends up above that. So that's a lose-lose for you. So you might end up having a double loss in that case, in which case you would be screwed, and this would amplify your initial loss. So that's bad, and this is why it's bad to chase. So that's it for the first scenario. Now moving on to the second scenario, which is hedging your bets. And this is essentially what a straddle is in its purest form, because this is neutral trading decisions, because you don't know what price will do. So you open a position in both directions. So here are the three possible outcomes again. In a perfect world, price would pick one direction and move significantly, and you would leave the trade in this direction open while closing the other one. This usually results in a profit, but doesn't happen that often, because this is basically arbitrage. Because you can just keep doing this forever, if you think about it. There are obviously other market factors that stop you from doing this. For example, some accounts don't let you short and long a position at the same time. You have to use separate accounts. Because if you could do long and short at the same time, you would just close whichever one is losing money and just keep the one that's open. And because of SEC regulations and all that stuff, that some accounts, depending on where you're trading with, won't allow you to do that. Alternatively, if you're trading vanilla options, you might buy calls and put options at the same time. The premiums that you pay will basically offset any profits you would make, so you wouldn't actually make any money. So it depends on what you're trading. Then for the ideal situation is you don't trade, because when you're in doubt, don't trade. Plain and simple. If you don't know what you're doing, don't take the risk. And here's why. Because in a bad situation, due to an imperfect world, you can't execute the first scenario properly. You're forced to keep both positions, i.e. when you're trading vanilla options or something, or if you can't go long and short at the same time, then one of them is going to lose while the other one profits, but your overall net will most likely be a small loss, or if you're lucky, maybe a small gain. But like I mentioned, due to market factors and due to rules and regulations, you won't be able to do this anyway, so you'll just be stuck with one position, and you take a loss with a stop loss, and you're done. So that's the neutral scenario. Now for the last one, hedging your profits. And this is very rarely done because it's kind of counterintuitive. So basically, we're starting at the green line. So this is your original position. You're hoping to go long, and price does indeed, it goes up tremendously. And so it moves in favor of you. But then after some time, price has gone up for, say, a couple hours or a couple days or a couple weeks or whatever. And then you're deciding, okay, maybe price is exhausted at this time and it might retrace. Now, a couple thoughts would go into your mind. Do you keep your position? Do you take a short position? Do you exit your position and take a new position? Or what do? The reason why people don't hedge their profits is because why bother? You're already in the profits. Just exit your position and enter the new one. Yes, that would work for short-term traders, but what if you're a long-term trader, etc.? And just an FYI, this hedging method for profits is instrument specific for those that can't exit your position, or it won't be cost effective. Or you want to keep your initial position for the long term and just want to hedge in the short term. And that's what I mentioned previously. Before I start on the three scenarios, I just want to say this. For this hedging method, all three scenarios are based on the fact that we're assuming that you are allowed to indeed open trades in both directions, because that's what the conditions are for. So just keep that in mind. So in a perfect world, you keep your initial position, you enter a short for a short-term trade down. If it profits a little bit, you take the profit, and then you exit, and you keep your original long position, and that just keeps moving up. So let's say your long-term projection is this is going to keep going up for the next year. But during the next couple of months, it might go down. So while keeping your long position, you trade the short-term down, and then you keep the long position for the rest of the year. And that's fine. That's a perfect world. But ideally, that won't happen, because in an ideal situation is you keep your long position, you enter a short, but instead of going down, the price just keeps going up. So you lose a bit of your profits in your long run, but then you exit your short, and then you have still your old position from before, and it just keeps going up. Then for the bad scenario, you exit your long position. Okay, so this last scenario is under the assumption that you are allowed to trade both directions, but you choose to exit. And this is a problem for traders, which will be done in another episode. But exiting trades is the hardest part of trading. Entering is hard, but exiting is just as hard or even harder, because when do you take profits? When do you take losses? Etc., etc. So let's say it's gone up to some point and you take your profits. Okay, great. And you think it's going to go down now. So you take a short. But what if instead of going down, price continues going up? So now you took your profits from before, and now you're taking losses on this trade. So this effectively reduces your profits, because you exited your old one already. Now you have a new position, which is the loss. But then if you don't exit this short in time, this loss might actually overcompensate the previous profits, and then you have a net loss, and that would be bad. So this concludes the three scenarios on hedging for losses, bets, and profits. So the positive, negative, and neutral. One last thought before we end off the lesson. Although I didn't mention the actual hedging amount, which will be covered in the trading series, by the way, here's something to think about. If you think back to money management, what percentage makes up your hedges? So let's say your trades were 5% risk. Do you risk the same for hedges? Or do you risk more or less? And is a hedge considered another trade, or is it simply a hedge? So these are the factors that you'll have to consider when you're hedging in the future. I wouldn't recommend hedging with a higher amount though, because this would be to make back your previous loss, which is a mentality of a gambler. And it's better in that case just to take a small loss over try to make a small profit. Because if you, let's say you enter with 5% and then you lose, the next trade you're going to be like, okay, I'm going to double up, so I'm going to enter with 10% so that if I make money, I'm going to get back the old 5% before. But what if this loses? If this loses, Originally you have 5% loss, now 5 plus 10 you have 15% loss. But if you had traded normally, 5 plus 5 would have been 10% only. So don't dig yourself a bigger hole. Just be strict with your money management style and just keep to your rules and you'll be fine. So that's it for this lesson. Hope you guys enjoyed this, and I will see you guys next time.